The American mortgage market has taken another hit, leading to predictions of a barren spring real estate market and calls for a cap on house prices. The real estate industry is bracing for significant layoffs as both commercial and residential sectors are severely impacted by the current economic downturn. Homebuyers are applying for mortgages at the lowest rate in almost 3 decades, as per a recent report from the Mortgage Bankers Association. The Mortgage Purchase Application Index has seen a 19% drop compared to last year, with the average monthly purchase index now at 156. The demand for mortgages is mirroring levels seen in the mid-1990s, indicating a cyclical pattern. Moreover, there are emerging signs of a potential crisis that could surpass the devastation of the 2008 financial crisis, but these warnings appear to be largely ignored. To understand the full scope of this situation, we need to trace back to the origin, the fundamental cause of this unfolding drama. If you've been following financial news, you're likely aware of the situation with New York Community Bank's non-performing loans. These are loans where the borrowers have ceased payments due to financial difficulties. As of December 2023, these loans have seen a reduction of $7 million or 2%, bringing the total to $428 million. This is particularly relevant to multifamily and office loans. Multifamily loans finance properties with multiple residential units like apartment complexes, while office loans are used for commercial office spaces. You might question the significance of this issue. However, a closer look reveals that the situation at New York Community Bank could be indicative of a larger trend in the American economy, hinting at potential economic instability. For instance, the San Francisco Chronicle reported a noteworthy event in the real estate market. Union Bank decided to sell its office headquarters located at 350 California Street in the heart of San Francisco's downtown district in early 2020. The building was initially listed for $250 million, a price considered reasonable at the time. However, 3 years later, the building sold for just $61 million, a staggering 75% decrease in price. This isn't an isolated incident. It's part of a nationwide trend that's leading to what's being referred to as the commercial real estate depression. The triggers of this depression are multifaceted. A significant factor is the rise in remote work that started after 2020. In fact, office attendance has stabilized at 30% below pre-pandemic levels. The decrease in commercial real estate value is a phenomenon observed from the West Coast to New York City. As more companies opt for remote or hybrid models, the demand for office space decreases, compelling landlords and investors to adapt to a new, albeit less profitable, reality. The current slump in commercial real estate is a stark sign of deeper societal and economic transformations that are reshaping our workplaces and our work methods. These sudden changes have naturally led to significant disruptions in the banking sector. Given these changes, there is growing consensus that these issues could be much more severe than previously anticipated. If you're not convinced, let's examine a specific instance that occurred recently. With approximately $116.3 billion in assets, New York Community Bank is a regional juggernaut and the 35th largest bank in the US. While it may not be as well known as Chase or Bank of America, it is still a recognized brand that ranks higher than many banks you might know, including Deutsche Bank. On January 30th, 2024, the bank issued an unexpected earnings report that caused its stock to plummet from $10.38 to $6.47 per share, a 37% drop in a single day. The bank's share price has fallen even further since it announced its earnings, hitting $4.20 as of February 6, 2024. This represents a 64% drop from its trading level just a week prior, making the recent decline more severe than those witnessed during the 2008 financial crisis. So, what exactly was disclosed in that earnings report to cause such a sharp investor reaction? It seems that the company has finally admitted that some of its commercial loans are problematic, and these loans will essentially be written off as substantial losses. As is well known, regional banks play a crucial role in the commercial real estate market, and most of them are heavily indebted. So why the sudden harsh response? Well, it is quite plausible in this particular case. A review of the earnings report reveals that in reality, this entire incident was ultimately caused by just 2 loans. It's possible that the borrower received a large amount of money upfront for capital expenses without adequate scrutiny or a correct assessment of the project's feasibility. This is pure speculation, but the use of vague language like pre-unit expenditures might suggest that the bank is trying to conceal a risky lending practice or a reckless decision. Now, before we proceed, if you found this video informative so far, please hit the like and subscribe button. It greatly assists us in creating excellent videos like this for you. Firstly, we had a cooperative loan with a unique feature that refunds even though the borrower was not in default. The loan was transferred to be held for sale during the fourth quarter. This might suggest that the bank did not exercise sufficient diligence to ensure that the funds were being used appropriately and effectively. Additionally, the term unique feature might suggest that this arrangement differs from standard lending practices, raising concerns about why this deviation was allowed and what potential risks it concealed. The second loan statement is equally troubling, suggesting a situation where the bank's laxity or leniency led to a problematic lending arrangement that ultimately resulted in substantial losses. Secondly, based on a revised valuation, we had an additional write-off on an office loan that became non-accrual in the third quarter. Cutting through the legal and financial terminology, we decided it would be wise to increase the ACL coverage ratio in response to the recent credit deterioration within the office portfolio. It's important to understand what this actually means. The subsequent sentence seems to suggest that the bank's office loan portfolio has experienced a broader trend of declining credit quality. As a result, the bank increased its allowance for credit losses to provide itself a larger buffer against any future losses. This indicates that the bank is expecting more challenges or defaults in its portfolio of office loans and is taking steps to mitigate the associated risks. The fact that all this trouble is caused by just 2 loans raises the question: what other confidential financial information is hidden in this bank's and other regional banks' financial records? If a small number of loans can cause such a panic, imagine the reaction if more problems emerge. Conversely, this crash also suggests that fewer people will be finalizing purchases this spring, which will lower home prices, especially in states where prices are already showing the most downward momentum. At this stage of the housing cycle, will there be a significant drop in property prices? Many remain pessimistic with fingers crossed. Let's briefly discuss the powder keg that is causing this drop in prices. On one hand, there has been a significant decrease in mortgage applications, which equates to a substantial drop in buyer demand in the spring. On the market supply side, we are also currently seeing an increase in mortgage defaults among existing homeowners. Again, this is where the banks come in. According to a report by the Mortgage Bankers Association, there was an increase in mortgage delinquencies during the fourth quarter of 2023. The delinquency percentage for mortgage loans on residential properties rose to 3.88% overall. Even though the total loan delinquency rate is still extremely low compared to historical averages, the rate at which new loans are becoming delinquent has increased, and some loans in particular have advanced into further stages of delinquency. When they break down these mortgage arrears by various loan types, they find that there is a significant increase in arrears on what are known as FHA loans. The current FHA loan default rate is 11%, much higher than it was before the pandemic in 2019. This is very concerning because over the next year we may see a larger number of FHA buyers, first-time home buyers who put down around 3.5% of the total purchase price, go into foreclosure. The reason for our concern, and why you should be concerned too, is that not only are mortgage delinquencies gradually rising, but credit card defaults are also rising at the same time. The fact that both of these events are happening concurrently with a rise in auto loan defaults indicates that American consumers are not in a good financial state. According to a CNBC report, the New York Federal Reserve saw a credit card delinquency increase of more than 50% in 2023 as consumer debt skyrocketed to $17.5 trillion, indicating financial stress. Of particular concern in this report from the New York Fed is the transition into 30-day delinquency by loan type. Credit card delinquencies in the blue transition to 30-day delinquency have surged significantly above pre-pandemic levels, and auto loan delinquency rates have also surged, rising slightly above pre-pandemic levels. At the same time, mortgage delinquencies are rising at a slower pace and are nearing pre-pandemic levels, with the exception of student loans, which we anticipate will also see a decrease in delinquency rates in 2024 when the forbearance periods end. Delinquency increases are being observed across the board. The rising defaults on credit cards, auto loans, and mortgages indicate that American consumers and homeowners are struggling to keep up, suggesting that something unfavorable is happening behind the scenes that could potentially lead to an increase in home inventory this year. The fact that the national housing inventory has not grown enough to cause the kind of price drops needed to make housing more affordable is what's driving this housing downturn. For those of you who are prospective home buyers, 2020 might be the year when we start to see this happen. The current lack of affordability is extremely severe, and even in some markets where prices have begun to fall, it's still quite challenging for buyers to compete in the current market for purchases, especially when demand is still at historically low levels and is unlikely to pick up. As more loans mature, further challenges may arise given the heightened sensitivity of all banks. Even a few property defaults can trigger a chain reaction that could destabilize the entire system. Not only are significant price drops just beginning to happen, but it's also becoming increasingly evident that the system is under significant strain. Could the commercial real estate sector be the trigger for a broader economic downturn? Please share your thoughts in the comments if you found this information to be very useful. Don't forget to like and subscribe to our channel for more financial insights.